I'd like to speak to you today about the vexed issue of retirement planning. And I say it's vexed because we live in very unusual times, and in order to get a good outcome, we've got to start thinking in some slightly different ways. By which I mean we're now in a period of low interest rates, and I can remember when rates were, for 10-year bond rates, were in 16+%, when the overnight cash rate went to 20%, which was a very, very different time. And of course, we're all told early on that you live off your interest and the importance of getting the highest interest rate that you can, etc., etc. However, that's not the case now. Interest rates are low, very low, and likely to remain that way for quite some time, for the simple reason that the world cannot afford high interest rates at the moment. The US Fed last year tried to push interest rates high, and the result was that the bond market and the share market tanked seriously. And eventually the penny dropped that with the amount of debt that's around in the world at the moment, the world simply cannot afford higher rates. I'm sure you've all seen many, many stories about the level of debt that is a mortgage debt that's lying around in Australia. And just imagine if interest rates went from the current rate of high 3s, low 4% per annum to something like 5 or 6% per annum. It would cause chaos. So anyway, what do we do? I've been in this business now for an awfully long time. I can remember when 10-year bond rates were at 16% plus. I remember when the overnight cash rate went to 20%. Okay, inflation was high, but the interest rates were much, much higher. Now, the reverse is the case. So we've got to really approach things in a new way. But fear not, there are solutions. Firstly, I think one of the solutions lies in Australian shares. Now, let me just make the point up front that I'm not recommending for one moment that you put all of your money in shares. The old saying of it, diversifying your investments, is true, remains true, regardless of what a lot of the other realities out there are. So, but nevertheless, Australian shares are attractive for a couple of reasons. Firstly, they pay high dividends. And there was a study done by the London Business School a few years ago, which showed that the Australian share market had been the best performing share market in the world over the last 100 years. And one of the reasons the authors of the study put down for that is that Australian shareholders demand high dividends, and this provides a discipline on boards of directors. At the moment, you're looking at the top 200 shares in the market. They're paying a dividend overall of about 4.5%. There is another sweetener out there too, which is franking credits. Tax which you can get back, which has been paid on your behalf by the company that pay the dividends. And now that the election has been and gone, we can safely say that they are safe for some time to come. They can add another 1 or 2% to the return that you get. So you're starting with 4 to 4.5, you're up now to 5.5 to 6.5%. A good fund manager will find other ways to add a bit of value like that, to adding to writing options over the shares, and maybe a bit of well-judged selling of shares that might be overvalued. And now you're looking at sort of 7, 8, 9% as a total return from that investment, plus a little bit of longer-term growth. Anyway, when it comes to arranging your portfolio, I prefer to use a layered approach like this, so that we've got a diversified portfolio. Layer 3 on the top there is made up of growth investments, which are Australian specialist fund managers and international managers who specialise not in income but in growth. They also pay some income. The extent to it fluctuates quite a bit from year to year, and a lot of it is distribution of realised capital gains when they've sold out of some growth stocks that they bought but they believe they've become overpriced. And then those distributions get paid down to your day-to-day cash account. The second layer is your Australian dividend payers, the ones that I've been talking about. From that, you're looking mainly at getting income, and a little bit of capital growth. And then the bottom layer, layer 1, is low risk, interest paying investments. These investments do not produce growth of any consequence. They may get a little bit from time to time, but fundamentally they are low risk income payers at a rate in excess of the cash management rate or the term deposit rate by 1 to 2%. Not a great return, but they play an important role, and their role primarily is to be a buffer, so that if the bottom falls out of the share market and you need extra cash, then you can take the money from this area and thus avoid selling your growth shares at knockdown prices. And that is very, very important when it comes to risk management. You don't want to become a forced seller of your growth assets at the bottom of the market. That way money can run out very, very quickly. And speaking of money running out very, very quickly, I think that risk is looked at in a whole range of ways in the financial planning industry, one of which is a volatility of returns, but I submit to you that in the retirement scheme, the biggest risk of the lot, and the one that you should really battle to avoid, is running out of money. Anyway, cutting to the chase, all of those distributions that you can see from the diagram come down and paid into your cash account. Your tax credits or your franking credits, to give it its other name, they're also paid into the cash account, and from that you take your day-to-day or month-to-month pension payments. This approach has a number of benefits. Firstly, it separates income from growth, and this I think is very, very important, because in the literature and in a lot of what you see, you will see total returns quoted. That total return is a combination of both income and growth, or in the event that something goes backwards in values, income less loss. But that is made up of two components, and the two components, the growth and the income, have quite different characteristics. And this is something which I think has been lost in much of the analysis that takes place. Anyway, the purpose of this structure, one of the purposes, is that you should be able to live mostly off the income, certainly in the short to medium term. Your growth investments then can have the time that they need to do the job that they should do for you. In summary, this approach I've been using now for several years with retirees, and it is working very well in terms of maintaining their account balance, except in situations, of course, where people have unanticipated and unplanned big expenses, and that's always another risk which is out there, and one which we really can't plan for. But certainly when it comes down to day-to-day living expenses, then it is largely fundable out of the cash flow. It also provides good risk management in that when it comes time to review your portfolio, we can see with a fair degree of transparency which investments have been performing and doing the job that was planned for them, and which ones haven't been, and therefore whether or not we should be making any changes.